Welcome to the Deep Dive. We sift through stacks of information to bring you the key insights, helping you get well-informed fast. Today, we're diving into a really specific and fascinating area of finance, profit distribution in Islamic investment accounts.
Yes, and our guide for this is Shari'ah Standard Number 40, Profit Distribution on Investment Accounts Based on Mudarabah.
Hmm.
It's quite detailed, really lays out how these financial partnerships work, especially around generating and sharing profits.
So our mission today is to really unpack the core ideas, maybe some surprising details too. We want you to understand what makes these accounts tick and, well, how they differ from the financial products maybe you're more used to. What stands out to you right away when we talk about these?
I think what's truly fascinating right from the start is how this principle of Mudarabah just shapes everything. Everything, from risk sharing all the way to how profits are handed out. It's genuinely structured as a partnership, not, a loan.
Okay, let's unpack that then. Mudarabah.
Yeah.
What are these investment accounts exactly, and how does this Mudarabah idea define them?
Well, at its heart, it's pretty straightforward. An institution takes funds from investors, like you perhaps, and acts as a manager of the Mudarib to invest those funds. The key thing is the relationship. It's a partnership. The institution brings the know-how, the management effort, and the account holders, well, they provide the capital.
And I see our source mentions two kinds, absolute and restricted. What's the difference there?
Yes, that's a really important distinction. Let's break it down. First, you have absolute mudarabah accounts, or mutala. Here, the institution basically has full discretion. They decide how to invest the funds, within Sharia guidelines, of course. Profits, assuming there are any, get shared based on ratios you agree on right at the start. But here's the crucial bit on risk. The account owners, the investors, bear all the losses, proportionally to their capital share.
All the losses. Wow.
Unless, and this is unless the loss came about because the institution did something wrong, like transgression, negligence, or breaking the agreed conditions. Only then are they liable.
Okay, so that's absolute. What about restricted?
Right. Restricted mudarabah accounts, or muqiyada. Here, the investment is tied to something specific, a particular project maybe, or a certain investment program that the account owner explicitly agrees to. So, much less discretion for the institution, it's targeted. Profits are still shared based on agreed ratios. But the loss side is slightly different. Each account owner bears the loss specific to their own restricted investment, again, proportional to their capital. And just like with absolute accounts, the institution is only on the hook for losses if they mess up through transgression, negligence, or violating the specific terms of that restricted mandate.
Okay, so this really highlights the risk aspect. For someone used to conventional banking, how fundamentally different is this from, say, putting money in a standard current account or even a savings account?
Yeah, that's a key question. The differences are pretty fundamental. The absolute biggest one, it's the guarantee of the principal amount. Your typical current account balance is usually guaranteed, right? By the bank, maybe deposit insurance, an investment account under Mudarabah. It's not guaranteed by the institution, full stop. Unless, as we said, the institution is demonstrably at fault. That really underscores the shared risk. You're in it together.
That's a massive shift in perspective for an investor.
It is. It requires understanding that you're an investment partner, not just a depositor. Then second, there's profit participation. A current account, you get your money back, that's it. No share of any profits the bank makes. With these investment accounts, profit distribution, according to those pre-agreed ratios, is the whole point. And the standard clarifies about savings accounts too. If they're set up for investment, they follow these Mudarabah rules. If not, they're just treated like current accounts. Simple as that.
Okay, the shared risk is much clearer now. But before any profit can be shared, it has to be realized, right? Not just on paper. What are the specific conditions for that?
This is where it gets really interesting, pulling in specific Islamic finance principles. It's quite meticulous. First off, capital safety. This is paramount. Profit is only considered truly realized and okay to distribute after the original capital amount has been recovered and is, safe and sound. Any money paid out before that point, it's treated as under account provisional, basically, subject to adjustment later if needed.
So no counting chickens before they hatch, financially speaking.
Exactly. Protect the principal first. Then there's this concept called tendid. It basically means liquidation or finalization. Profit is only properly achieved after the investment period is finished, either through actual liquidation, selling the assets for cash, or what they call constructive liquidation. It means you determine the real profit or loss by finalizing things, not just based on estimated values or projections. It prevents distributing paper profits.
Makes sense. And what about covering costs? I imagine there are rules for expenses before you get to the distributable profit.
Oh, absolutely. Very precise rules. Direct costs tied to a specific investment. They come out of that specific operation's earnings. Make sense? Joint expenses, things that relate to all the investment accounts together, can be covered. But, and this is important, this doesn't include the institution's own internal operating costs for its general business. So things like general management, overhead, follow-up, basic accounting for the institution itself, those costs are the Mudarabah's responsibility, not the investment account holders. They're providing a service. It is allowed, though, to agree on a ceiling for those joint expenses that are chargeable, just for transparency.
So it's not just a free-for-all on expenses. It sounds very disciplined, protecting the investor's potential return. What about setting aside money for rainy days, provisions and reserves?
Right, those are crucial, too, for getting the profit figure right. Provisions and reserves get deducted from the gross profit. For instance, they can set up an investment risk reserve. Okay. Now, this reserve is deducted after you've already offset losses from one investment operation against profits from other current operations in the same period. You can't use profits from a completely different year, though. And generally, if losses actually eat into the capital itself, this reserve can't be used to cover that. Its purpose is more for smoothing out operational profits and losses within a period. There's a small exception for offsetting profits from long-term projects proportionally, but the main principle holds.
Okay, so a very careful calculation. Once you have that properly realized net distributable profit, how is it actually shared? The rules around entitlement and the distribution itself must be critical.
Absolutely paramount. The standard insists. The method of distribution and the exact ratios must be known and agreed upon when you sign the contract. No ambiguity. Critically, you cannot specify a fixed amount of profit for either the investor or the institution, nor can you promise a specific percentage of the capital as profit.
Why is that forbidden?
Because either of those would effectively guarantee a return, right? It would make it look like a loan with interest, which goes against the core Mudarabah principle of shared risk and actual profit participation. Any method that might lead to one party essentially not sharing in the real profit or loss is also out. And you can't delay deciding the ratios until later. It has to be done up front.
What happens if somehow the contract forgets to mention the ratios?
Good question. If the contract is just silent, you first look to customary practice in that market, what's usually done. But if there's no clear custom either, the Mudarabah contract itself becomes void, invalid. In that case, the institution just gets paid a fair wage for the work they did, a customary wage. And all the profit goes to the capital owner, the investor. It really hammers home the need for clarity from day one.
Interesting. So huge incentive to get the contract right.
Definitely. However, it is okay for the profit ratios to be different between the institution and the account holders, and even different among various account holders themselves. So there's flexibility in the structure. Oh, and another point. If the institution, the Mudarabah, decides to put some of its own money into the pot alongside the investor's funds, then it becomes a partner through its capital too, not just the manager. It shares in profit and loss on that capital just like everyone else.
Okay, that covers the agreements. What about the sort of day-to-day mechanics? How are distributions actually handled? Any other operational rules we should know?
Yeah, let's get into the practicalities. The source mentions something called the NIMR account. It sounds complex, but it's essentially a method for calculating profit shares fairly. Think of it like a weighted average calculation. It takes into account both the amount of money you have in the account and how long it's been invested, duration times currency unit. So someone who invested more or kept their money in longer gets a proportionally larger share of the profit generated during that period. Seems fair.
Right, it ensures equity based on contribution over time.
Exactly. And remember we talked about realizing profit via Tendid. Well, it is allowed to distribute some amounts under account before that final liquidation happens. This helps with cash flow for investors. But everyone knows these are provisional payments, and they'll be adjusted later, either topped up or clawed back slightly once the final profit is known.
So some flexibility there. What about advertising expected returns?
An expected profit rate can be mentioned, maybe in marketing materials. But, and this is key, it is absolutely not binding. The final distribution is based only on the actual realized profit after Tendid, not some initial projection.
Got it. What about funds that just sit there, unclaimed money?
Ah, yes,
Wow.
unclaimed funds. The standard has clear rules. If they can't find the account holder, new address is unknown, etc., the money goes into a suspended account for a while. If, after a set period, they still can't locate the owner, the funds get transferred to a designated charity account. Now, if the owner does eventually surface and didn't approve that charitable spending, they get compensated. But from the charity account itself, interestingly, the standard even suggests putting a clause in the terms where account holders agree to waive rights to the funds going to charity if they remain unreachable after a specified time. It's a very practical, ethical approach.
That's quite thorough. And what if the institution wants to change the rules later on, like the profit ratios?
Good point.
Mm.
Ideally, they'd get explicit consent from every account holder. But practically, that can be tough. So the standard says it's generally sufficient to send out notifications or post clear statements on their website, setting a deadline for objections. If you don't object by the deadline, your consent is assumed and the new terms apply from the next investment period. And finally, if things do go wrong and there's a dispute, the standard points towards resolution through experts in Islamic finance, maybe arbitration, or ultimately the courts. Importantly, if an account holder claims the institution was negligent or violated the terms, the burden of proof is on them, the account holder, to demonstrate it.
Wow. This deep dive has really shone a light on just how intricate, but also how principled these Mudarabah-based Islamic investment accounts are. It's clearly not just another way to package a loan. It feels like a fundamentally different financial philosophy.
I think so too. We've really seen how starkly they contrast with conventional banking. That core emphasis on shared risk, it changes everything. And the meticulous process for recognizing profit, that Tandy concept, the careful expense rules, plus the absolute clarity required upfront on how profits are shared, it really is a model built on partnership, transparency, and clear ethical guidelines, rather than a simple debt relationship focused on interest.
It certainly leaves you with a lot to think about. And maybe for you, the listener, here's a thought to ponder. In a world often focused on debt and guarantees, what might happen if more financial systems embrace principles of shared risk and genuine partnership? Could that lead to maybe more stable or inclusive economies? What are the biggest hurdles or perhaps opportunities in applying such a model more broadly in our diverse global economy? Something to mull over.